Every dollar you miss because of bad record keeping, you're paying 25 cents in tax. As soon as I'm in the pursuit of income, I would start an LLC.
What are some common things that you think independent creators forget to deduct that they should?
Home office, cell phone, meals, and travel.
And so let's start it off though, Matt, with just kind of the mindset. Some people think this is complicated, this is overwhelming, why should I even learn this? For a newer entrepreneur, a newer YouTube creator, somebody that's just coming into making money, a small business owner, why do they need to learn this, and what's like the right frame of mind to get in?
I think the main reason is that saying of the way you do anything is the way you do everything. And so it may seem hard up front, but if you spend an hour, 2 hours understanding what you need to do correctly, which we'll go over, it's really easy and it's going to set you up for a ton of success going forward.
What's the 30,000 foot level though of why someone should start a side business, and why is YouTube technically a business?
So first, YouTube is technically a business because you are self-employed. YouTube is paying you not as an employee, you are a subcontractor, right? You are making affiliate income from using their service. The reason I would go back to why I would start a business in today's society, in today's world, is because if you're a W-2 employee, you get a paycheck and that's it. If you make $50,000 on paper, you're gonna pay tax on $50,000, given a couple things you can do to lower it or increase it, but that's it. Once you're self-employed, you literally have the entire tax code at your disposal to try to bring it down to zero. So I would much rather be somebody making $50,000 as a self-employed contractor and pay zero in tax than to be a manager at a department store making $50,000 and paying $5,000 to $10,000 in tax.
What do you technically need to do to become self-employed?
Earn money by performing self-employed services.
So you technically don't have to start an entity to actually be self-employed. As soon as you start collecting money, which here in the US would be like 1099 income, self-employed income from anywhere. If YouTube pays you some monetization, you can start earning some money. But the key thing here is someone might say, oh, well, my YouTube channel is not making any money yet. I haven't started a business. Is that true?
No.
So when you start the businesses in a way, it's when your mindset, you say, I've decided to start.
Exactly.
Even without starting an entity.
That is one of the biggest misconceptions, is that you need an LLC or an entity or a corp to take deductions, and that is so far from the truth.
And so then what are the benefits of becoming an LLC or having a DBA or opposed to a sole proprietor? What's the difference?
Legal protection. And that's where a lot of people get caught up. They think they need an LLC for tax benefits. Not the case. The only reason you would really get an LLC is to formally start a business and separate the liability of you doing business from your personal self. As soon as I'm in the pursuit of income consistently, I would start an LLC. So if I'm gonna go into YouTube and buy equipment and put a plan together to film, I'm gonna set up an LLC at that point.
We intend to make money. How much do we actually need to be earning for us to actually get tax savings?
You don't need to earn anything because, let's be honest, most people when they start their businesses, they're gonna buy equipment and they're gonna purchase things and they're not gonna make a lot of money. So it's very likely in year one, you're gonna have more expenses than you do income, which is gonna be a loss.
When do I start getting taxed? How much money, or what am I taking that loss against? So if in the first year of doing YouTube, no money comes in, what am I writing off? If I spend $20,000 on camera, building a studio, paint, track lighting for my studio, right off the couch that's in the background of my studio, and we'll get into deductions in a second. I'm kind of getting ahead of myself. But what am I actually writing off in that? Am I able to write that off against my W-2 income?
Yes, and I was gonna say that's my favorite strategy for somebody that's just starting a business, because let's say you are a department store manager making 50K and you go out and start a YouTube channel, you buy some equipment, you buy a laptop, you buy a mic. You are going to deduct some of those costs against no income. You likely won't make anything your first year.
Yes.
And now, what did we say up front? If you make 50 grand as a department store manager, you're gonna pay tax on 50 grand. Let's say your business, you lose 3 grand because you paid for equipment to start up. Now you can net that 3 against your W-2, and now I made $47,000 on paper. So now some of those taxes I withheld on my paycheck, what do I get? A bigger refund.
So this is the unlock, record keeping.
Oh,
why is
the
that?
biggest?
And people hate that.
Oh, they hate it.
But why is that so important?
Because at the end of the day, it's going to save you money with your accountant. I'll be honest, if somebody comes to us now and they have clean records and one of them has messy records, the person with messy records is going to get a higher bill. Why? Because we have to spend more time on their work. And two, tax planning, which is a little bit more in episode 2, that's where the money's made. That's where you're going to sit down and strategize on how to bring your income to zero on paper, right? And help you make money and pay zero in tax. You can't do any of that unless you have your books ready. And what do I mean by books ready? For those of you listening, could you come to me on Monday? This is what I always like to ask, and sit down with me to tax plan, but could you show me a year-to-date profit and loss? Could you show me what your expenses were? Most of the time, that answer is no.
If someone's trying to kind of do this on their own and they want to prepare for this, is there a software you recommend? Get this software and start plugging numbers into this.
QuickBooks Online. You can sync your bank account directly to it, and it will feed the transactions in. It's as simple as you bought a meal, drop-down menu, meals.
Got
You
it.
paid for a Netflix subscription for your office, for your clients, subscriptions.
Let's talk about deductions. So the funny thing is there's that meme, right? There's that meme of like, it's a write-off, it's a deduction. What does that mean? It means it was free. It means I bought a camera, my camera was free. Well, that is a myth, right?
Yes.
Let's just talk about why deductions. How much are people really paying in taxes? And how much are taxes actually costing people? When I think people think their biggest expense is they think it's their internet bill is their biggest expense. Their coffee bill is their biggest expense. Their mortgage bill is their biggest expense. How much are people actually paying in taxes?
Let's think about it this way. If you're at the 25% tax rate between whatever state you live in and federal, every dollar you miss because of bad record keeping, you're paying 25 cents in tax. So that's why it's so important to keep track of your expenses and your deductions.
So
But I would say 25 to 50% in overpayment of tax because of bad tracking.
which is absolutely massive. So
Insane.
So let's. A lot of people are probably not making 6 figures a year, but let's just round it because it's easiest math for me. You make $100,000 a year at 25%. You're going to pay $25,000 to the IRS. That's assuming your income is net, $100,000.
Net.
So theoretically, then, with proper deductions and tax strategy, you could pay, instead of 25, you could pay 20. Instead of 20, and theoretically, you could pay 0. Especially,
I'd say on average, they should be falling 10 to 15.
so that'd be $15,000 back in your pocket.
Back
So
into your business.
and back into your business, reinvest. So you're talking about, if you make $100,000 a year, you're probably paying the IRS $25,000 when you should only be paying them like 15, and you're keeping the other 10 or reinvesting it, et cetera. And you have more to show for it after.
Exactly.
Now you have that next office you want to upgrade to, that next vehicle you want to upgrade to for your business, whatever else. Okay, so then ultimately deductions, what are some common things that you think independent creators forget to deduct that they should?
Home office, cell phone, meals, and travel. Those are some sleepers that really
Okay, let's
add
hit
up.
them. So home office. So what can you do to write off your home office? How does it work?
So honestly, your CPA should give you a template to really track this, which again, we can give to you and then you can send to the listeners. But for example, if you work out of your home, your power bill now has become partially deductible. Your internet bill, your cable bill, the equipment that we're using. So I know in my office, I have a desk, I have a chair, I have cameras, monitors, all of that can be deductible. So keeping track of all of that is really important.
And you do that based on square footage.
Exactly. So for things like your cable bill,
Yeah.
your office, let's just say, is 10% of the square footage of your entire home.
Yep.
Which is square foot of your office divided into square foot of the entire home.
Yep.
You get 10%. All of these general utility bills of your entire house could ideally be allocated 10% towards your business.
So some specific advice here. We're here in Anderson Studios. That's where we film the Think Media podcast. And he actually has devoted an entire loft, an entire office, an entire closet, and an entire bathroom. Because, and for the IRS too to know, there's other bathrooms, there's a whole downstairs, so this is entirely devoted to business. He's also able to lease this out, sublease it to us or whatever, and others. And he's able to use this space. So it's entirely devoted to business. It's also then quite a bit of square footage. It
I was
might
going to
be,
guess this is at least 500 to 700 square feet, 400 to 700 square feet in what I'm seeing here.
yeah. So then let's just say it was 20% of the entire house, because this is much bigger. And then he's got a lot to show for it, videos to show, bigger than a normal home office. Production is happening here. So would you then say your electric bill, you're gonna write off 20% of your electric bill, the percent that is the square footage of the office.
Exactly.
And then you could apply that to water and everything.
Mortgage interest, if he rented this place instead of owning it, not sure which one, but even if you rent the property, that now portion of rent is deductible.
And if you don't rent it, but you have a mortgage, you can write a percentage of mortgage interest off.
Exactly, because your principal is not a deduction.
Sheesh. Okay, so home office is gnarly. And stick with us. I know this episode's already kind of crazy, but that's a big one. You also said cell phone. Are you going to write off 100% of your cell phone?
The majority of it, right? So like that's where you start to get into why would you track miles? Why do you track allocations? Is because some things that you purchase in life, and that's one of the best things about being self-employed, you mix business and pleasure. So I'm going to use my cell phone for business and I'm going to use it for personal use. So if I think that I'm using my cell phone because I'm mainly on it 70, 80, 90% of the time for business, or I have a separate cell phone just for business, then I'm writing that entire thing off. But yeah I'm definitely going to take a portion of my cell phone.
Percentages was one of the biggest secrets that I learned that changed everything for me, because I kind of thought it was this all or nothing
That's
thing.
why they're sleepers, because people think they're all or nothing.
Yeah,
Like, I've used it personal, I can't use it.
I use my car, I went to the grocery store, and like it's not 100% business, but percentage is, and what is the IRS asking? Is it what, reasonable, ordinary?
Ordinary and necessary. Is it ordinary that someone else in this business would spend money on this? And is it necessary for me to pursue my income, which doing deals, talking to clients on a cell phone is very reasonable.
Okay, so home office, smartphone, what was the other one?
Meals. And that's because now it's 100%. That just shocked the entire tax community when that came out.
So how do I write off meals? What would be a legitimate meal that I could write off?
Me and you going to dinner to discuss working together.
What about me getting coffee on the way over here for this workday?
If you brought coffee to us, yes. If you bought coffee for yourself, technically no.
Okay. So
see the difference. You got to be doing something with a colleague or an employee or a prospect.
Got it. So if I take the Think Media team out, or a team member to have a leadership conversation to talk about things, a hire, I take you out as a client or somebody we're collaborating with, I could write that off 100% right now.
My favorite thing to do.
And that changed recently.
It used to be 50.
Yeah.
So somebody would come to us with 10,000 in meal expense. They would only get 5. But because of COVID and the restaurant industry getting hit so hard this is an exact example of how the government stimulates spending through tax code. They're like, hey, restaurants are getting crushed. We want you to spend money in the restaurant industry. We're going to give you 100% deduction. What do you know? People are spending money like crazy now on dinners and going out because it's fully It's fully tax deductible.
So you talked about home office. You talked about meals. You talked about phone. What were the other ones?
Travel.
So you can write off travel. So are you telling me if I'm going to go to Think Media's conference in Las Vegas that I could write that trip off?
Yes.
So how's that work?
So the thing you want to keep in mind with travel is a 5149 rule.
Okay.
If I'm going for 4 days, I want 3 of it to be for business. That allows me to write off the transportation too.
Okay.
So you can see and you hear people say wrap the weekend, meaning let's go on a Thursday. We'll work Thursday, Friday. We're going to play Saturday, Sunday, and we're going to work Monday. That entire trip is deductible now for my travel costs to get there. So 5149 just being a quick rule of thumb of how many days am I going to spend here? And is the majority of it going to be business? If so, yes on writing off your travel.
So if I buy a ticket to Think Media's conference in Las Vegas, I could write the ticket off. I'm going to write the airline off. I'm going to write the hotel off. I'm going to write meals off while I'm there. It's a business trip.
I'm going to write my Uber off to get there.
I'm going to write out the Uber off. And then, of course, if I buy some souvenirs or whatever, that's personal.
If I buy a cool Think notebook that I'm going to use to keep my business notes in.
If I buy Think Media merch, that's related to, okay.
Yeah.
What are the tax rates? So now thinking about this, and again, this information's obviously, we're talking here in the US, you got to look at your local, area, but it's a bracket system. What does that mean?
So a lot of people get confused where they think, oh, I'm at this bracket, which is, let's say 24%. I'm going to pay 24% on all of my money. And that's not how it works. So if you want to pop up what the brackets are here, the way that the bracket system works is you're going to pay X amount of dollars or you're going to pay X amount of tax on so many dollars. And then when you move to the next bracket, you're only going to pay that new rate on those amount of dollars and those amount of dollars. So you consistently move up. Like for example, the top tax rate, 37%, you're only going to pay that on money over, let's say 530,000 or 470,000, whatever
Net
it is.
income.
Yes, net.
So if you make 500 or whatever thousand, and then you make another 500,000, you're only going to pay 37% on the past.
Exactly, past that number.
Got it.
Yes. And that's where you bring up a good topic too, which is on net income. So for example, if my business made $100 before expenses, I'm not going to pay tax on $100. I first get to take my expenses against it. And let's say it brings me down to 80, I'm going to pay tax on 80.
Yeah.
So that's what a deduction is. It just lowers the amount of money subject to tax.